Hi candidates, welcome to another session of manifested online classes. We are still continuing the topic of group accounts, and so far we have been able to look on how to prepare the consolidated statement of financial position, and actually the various consolidation adjustments which are necessary and which you need to know specifically in preparing a consolidated statement of financial position, specifically whereby the parent company has invested in a subsidiary. So in this session, I want us to continue and look on how to prepare a consolidated income statement or a consolidated statement of a profit and loss, which is also known as the consolidated statement of comprehensive income, and equally some of the consolidation adjustments which are necessary and basically which you must be in a position to deal with anytime you come across a question for a consolidated statement of profit or loss. Remember what we said is that a subsidiary is basically an entity over which the parent company is having a control. Basically, we say that a parent company exercises control or basically have a control over a subsidiary or basically over the investee company, whereby the parent company has acquired shares which lies between 51% to 100%. Therefore, what we said is that the parent company is required at the end of each financial year to prepare the group account or to prepare the consolidated financial statement by combining or basically by adding together similar items of assets, liabilities, revenue and expenses, those of the parent and those of the subsidiary. And actually, so far we have been able to see how to prepare a consolidated statement of financial position. So when the parent company is preparing the consolidated income statement, the parent company should do that by adding together or basically by combining similar items of revenue and expenses, those of the parent and those of what? Of the subsidiary. But equally in this case, there are a number of consolidation adjustments which are necessary during the preparation of this consolidated income statement. So therefore, first of all, you can say that this is prepared by combining or adding together similar items of revenue and expenses, those of the parent company and those of the subsidiary. So basically what that means is that when the parent company is preparing the consolidated income statement, and then it do that by combining, or in other terms by adding together a similar item of revenue and expenses, those of the parent company and those of the subsidiary. And also it is very, very important to note that when taking into account the items of revenue and expenses of the subsidiary, we take 100% of those particular items, even if the parent company do not have a 100% what shareholding. Like maybe let's assume that, or we assume we are told that A Limited acquired 80% of the issued equity or ordinary shares of B Limited. So basically what that means is that A Limited here will be is the parent company, whereas B Limited is a subsidiary, and therefore the parent company here, that is A Limited, is the one which is under obligation to prepare the group account and specifically to prepare the consolidated income statement. So we are saying when the parent company is preparing the consolidated income statement, then it should combine, it should add together similar items of revenue and expenses, those of the parent and those of the subsidiary. And also we are saying that when the parent company is taking into account items of revenue and expenses, those of the subsidiary, then the parent company should take 100%. Or in other terms, if you come across a question whereby you're required to prepare consolidated income statement, when taking into account the revenue and expenses of the subsidiary, even if the parent company has not acquired 100% of the shares in the subsidiary, always you take into account 100% revenue and expenses of the of the subsidiary. That is very, very important. So basically what that means that when taking into account the revenue and expenses of the subsidiary, you should not multiply that with 80%, but you take the full amount of revenue and what? Expenses. Now, equally, when this consolidated income statement is to be prepared, we have a number of consolidation adjustments which are necessary and which you must be in a position to deal with. But even before you look on how to deal with the various consolidation adjustments, first of all, I want us to look on the consolidation procedures. Which steps do you need to follow? For example, anytime you come across a question whereby you are expected to prepare a consolidated income statement. So let's start by looking on the consolidation procedures. Consolidation procedures. So in this case, when we talk about the consolidation procedures, basically you're talking of the steps which need to be followed. Number one, we have said that the parent company and subsidiary company results. So in this case, when we talk about the results, we are talking of the revenue and the expenses. We are talking of the revenue and expenses. Those of the parent and those of the subsidiary should be added up in full. So in full means what? In full means that when taking into account the revenue and expenses of both the subsidiary and the parent company, you take 100%, even if the parent company do not have a 100% shareholding in what? The subsidiary. So the parent company and the subsidiary company results should be added up in what? In full. Number two is that for a subsidiary acquired during the current financial year, take into account its results, basically that is revenue and expenses, from the date of acquisition, i.e. time apportioned. So basically, what we mean by this, basically we are saying here, for a subsidiary which is acquired during the current financial year, you take into account its results, that is its revenue and expenses, from the date it was acquired. It basically means that if assuming the current financial year of the group maybe is ending on 31st of December 2023. So and basically that is when the date you are required to prepare the consolidated income statement. That particular date we refer to it as the date of consolidation. And we also assume that our subsidiary was acquired on 1st of July 2023. So this one we refer to it as the date of acquisition, abbreviated as DOA. So in this case, when preparing the consolidated income statement, we take into account the revenue and expenses of this particular subsidiary from the date it was acquired, and that is 1st of July 2023 to 31st of December 2023. And basically in this case here, we have 6 months. So basically what that means is that when taking into account the revenue of the subsidiary, we only take the revenue for 6 months. We multiply that, we take the revenue of the subsidiary times 6 all over 12, and then that will also apply to the expenses of what? Of the subsidiary. So therefore, anytime a subsidiary has been acquired during the current financial year, when preparing the consolidated income statement, we only take into account its results, that is its revenue and expenses, from the date it was acquired to the date of consolidation, basically you apportion the revenue and expenses, or basically you multiply the revenue and expenses on time basis, basically from the time the acquisition took place to the date of what? Of consolidation. Very, very important. But it's also important to note that if the subsidiary was not acquired during the current financial year, maybe it was acquired like 2 years back, 3 years back, 4 years back, when preparing the consolidated income statement, we take into account the revenue and expenses for the subsidiary for the whole year. We consolidate, we add them together with those of the parent company. So therefore, that is a procedure, or basically step number 2. Number 3, when preparing the consolidated income statement, we also eliminate what we refer as the intra-group trading, or basically what we refer as intra-group sales. So what do you mean by intra-group trading or intra-group sales? So this is basically sales between the group members. Like assuming we have or we are told the parent company made some sales to the subsidiary, or vice versa, the subsidiary made some sales now to the parent. We refer to this as intra-group trading, or basically intra-group sales. And actually what we said, or what I mentioned in the previous sessions is that when preparing the consolidated financial statement, then the parent company and the subsidiary are always assumed to be one and a single entity. And therefore, anytime we have sales between these two group members, then that is viewed to be a transfer from one group member to the other. So it should not be accounted for as sales. It should not be accounted for as sales when preparing the consolidated income statement. That's why we are saying that any sales between the group members should be eliminated when preparing the consolidated income statement. So in this case, it is important to note that if the parent company here made or sold some goods to the subsidiary, this company will have accounted for that as sales, whereas now this particular company will have accounted for that as purchases, or as basically part of the cost of sales. And therefore, in preparing the consolidated income statement, preparing consolidated income statement, what we are saying is that we should take the revenue of the parent plus that of the subsidiary. And then in this case, we are saying if there are some sales between the group members, that should be eliminated from this. So to this, we eliminate what we refer as intra-group sales. And also the same should be eliminated from what we refer as the group cost of sales. So once we add the cost of sales of the parent plus that of the subsidiary, we also eliminate, or basically we deduct what we refer as the intra-group sales or intra-group trading. So the step number 4 is that we also eliminate what we refer as the intra-group investment income, income. So when talk about intra-group investment income, we are talking of any investment income which is generated within the group. A good example of such is dividend, or basically are dividends received by parent company from the subsidiary company. So definitely it is important to note that if the subsidiary company pays some dividends, some of those particular dividends will be paid to the parent company. So if, for example, we are told that this company paid some dividends amounting to 100,000, and we are also told that the parent company has 80% shareholding in the subsidiary. So it is obvious that 80% of this particular dividend will be paid now to the parent company. So once the parent company receives those particular dividends, the parent company account for them as an investment income. But that particular investment income accounted for by the parent company, and which are the dividends received from the subsidiary, this one we say is an investment income generated within the group. and therefore that one should not be included in the consolidated income statement. So the investment income to be included in the consolidated income statement should be the investment income generated outside the group. If, for example, the parent company or even the subsidiary has invested outside the group by buying shares, or it has also invested in debt instrument but outside the group, that is now what should be included in the consolidated income statement. And finally, step number 5 is that once you have gotten the profit for the year, after preparing now this particular consolidated income statement, that particular profit for the year should be splitted between the profit attributable to the parent and the profit attributable to the NCI. So step 5, we can say split the profit for the year, the profit for the year between the parent, between a parent company and the NCI. That is non-controlling interest. So why do we do that? Why do we have to split the profit for the year between the parent and the NCI? Is because if you can remember what we said in step number 1, is that we take into account, or basically when preparing the consolidated income statement, we take into account the results of the parent company and the subsidiary, or in other terms, we combine the result of the parent company and the subsidiary in full. What that means is that even if the parent company do not have 100% shareholding in the subsidiary, always we take into account 100% the revenue and expenses of the subsidiary. Basically, what that means is that the profit for the year which will be included in the consolidated income statement is always 100%. But the parent company is not entitled to a share, or basically is not entitled to share the full amount of the profit reported by the subsidiary, because in the subsidiary we also have other shareholders. For example, if the parent company has a shareholding of 80% in the subsidiary, it means that the parent company is only entitled to share a profit of 80% reported by the subsidiary, and the remaining 20% of the profit is a profit which now the minority shareholders, or basically the NCI, are entitled to. And that's why we are saying, once you have determined the profit for the year, then that particular profit you should split it into two, into profit attributable to the parent, the profit attributable to to the NCI. So how do we compute the profit attributable to the NCI? So let's look on how we compute the profit attributable to non-controlling interest. Profit attributable to non-controlling interest. So in this case, what we do is that we take the subsidiary company profit after tax. So this is now the profit after tax reported by the subsidiary. And in this case, you also have to be very careful here. If a subsidiary was acquired during the current financial year, for example, 6 months to the end of the year, 9 months to the end of the year, you don't take into account the profit for the whole year here. So you take now the profit of the subsidiary from the date it was acquired to the end of the year. So if it was acquired 6 months to the end of the year, you only take into account the profit of the subsidiary for 6 months. If it was acquired 9 months to the end of the year, you only take into account the profit of the subsidiary only for 9 months. But if it was acquired before the start of the current financial year, you take into account the profit of the subsidiary for the whole for the whole year. So you take that particular profit of the subsidiary, that is profit after tax of the subsidiary, and this particular profit should be adjusted with a number of items. Like 1, if the subsidiary company had any unrealized profit on inventory, this one should be eliminated here, should be deducted there. If this company had any depreciation other charge during the current financial year as a result of the fair value exercise, this is something we discussed in our previous session, as a result of fair value exercise or fair value adjustment, that depreciation other charge should also be deducted should also be deducted here. If this company, for example, had any depreciation overcharge, mostly due to intra-group sale of non-current assets, that one should be added there. So, and then you get now the adjusted profit for the year. Then what you do, you compute the NCI share of this profit. How do you compute the NCI share of this? You have to multiply that with the percentage NCI. Like in this case, the percentage NCI is 20%. Multiply that with the percentage NCI. And then in this case, you'll do what? You'll get now the NCI share of that profit. But equally, if you compute the goodwill on acquisition using the full goodwill method, and that goodwill was impaired during the current financial year, you also have to compute the NCI share of the impairment loss. NCI share of impairment loss, and you less it from that particular profit. So whatever you get there, that one is the NCI, or basically this one is the profit after tax, which is attributable to the non-controlling interest. To the non-controlling what? Interest. So therefore, this is how you determine the profit attributable to the NCI. And basically, once you have determined that profit attributable to the NCI, then you'll also be in a position to determine the profit attributable to the parent company, because having prepared this consolidated income statement, automatically you'll have determined the profit for the year, and this we are saying is the profit which should be splitted into two: profits attributable to the parent, profits attributable to the NCI. So in our case here, you have computed the profit attributable to the NCI. So you will say that this profit for the year is attributable to number one, NCI, profit attributable to NCI. You'll have computed that here using the working which I've shown you there, and then here you also determine the profit attributable to the parent company. So the profit attributable to the parent company, we can say will be equal to this A minus B. This one will be equal to A, whatever you have there, minus B. That is how we determine the profit attributable to the parent entity. So therefore, these generally are the consolidation procedures, or basically are very important steps which you need to know, and which are basically followed in preparing the consolidated income statement anytime now the parent company has invested in a subsidiary. Now, before we look on an illustration, there are some key consolidation adjustment here which are made in preparing a consolidated income statement, which you must be aware of, and also which you must be in a position to know how to deal with them, specifically in preparing a consolidated income statement. Therefore, I want us to briefly look on them, but most of them are basically related to what we have discussed in our previous sessions. Adjustment to do with the unrealized profit, adjustment to do with the intra-group trading, something I've already mentioned here, adjustment to do with the depreciation, overcharge, other charge. So therefore, this is just a summary of some of the concepts which I've already discussed in our previous sessions. So we look on those consolidation adjustments. So we can say that this include number one, we have adjustment relating to intra-group trading, or in other terms, intra-group sales. Number two, we have adjustment relating to unrealized profit on inventory. Unrealized profit on inventory. We also have an adjustment relating to depreciation, other charge or overcharge. Depreciation, other charge or overcharge. We also have adjustment in relation to any impairment loss. Yes, so I think these are some of the key consolidation adjustments which we need to discuss here. So let's start with the first one here, intra-group trading. So when talk about the intra-group trading or intra-group sales, this refers to any sales between the group members. For example, the parent company selling some goods now to the subsidiary, or basically vice versa. And any sales between the group members, we have said this one should always be eliminated from the consolidated income statement, because anytime the parent company sells some goods now to the subsidiary, from the group point of view, that is purely viewed as a transfer from one group member to the other. And therefore, you have said, as a summary, this one should be eliminated. This one should be eliminated from a group sales, or basically the group revenue and group cost of sales. Group cost of sales. Basically, to be eliminated means that once you have added the revenue of the parent and that of the subsidiary, eliminate any sales between the two, between the group members. You deduct it. Equally, once you have added the cost of sales of the of the parent and that of the subsidiary, eliminate any sales between the group members. So that is very, very important. So also, anytime we have intra-group trading, or basically intra-group sales, this is something we discussed in our previous session, that this will also give rise to something called the unrealized profit on inventory. This will give rise to something called the unrealized profit on inventory. And first of all, you have to recall how we compute this unrealized profit from what we have already discussed in our previous sessions. To compute the unrealized profit on inventory, we take the unsold goods times the gross profit margin. Actually, we said unrealized profit arises whereby we have sales between the group members, but the goods now which were sold to the buying company or to the purchasing company remain unsold, or basically some of those particular goods will not have been sold to third parties, remain unsold at the end of the year. So the profit reported on those goods not yet sold, then we say is unrealized profit, is unrealized. So this is how we compute it. So this particular unrealized profit on inventory, when preparing the consolidated income statement, this one is supposed to be added to the group cost of sales. Is added to the group cost of sales. Very, very important. So then we also have the other adjustment here. Number 3, adjustment relating to depreciation, other charge, or overcharge for current financial year. For current financial year. So first of all, from what we discussed in our previous session, you also have to recall that depreciation, overcharge, or other charge by the subsidiary company arises whereby the subsidiary company or the date of acquisition revalued the asset but never accounted for that. So any depreciation, overcharge, or other charge purely for the current financial year is also taken into account in preparing the consolidated income statement. But the first thing you have to recall here is that depreciation, other charge, this one we said arises whereby the subsidiary company revalued the asset and there was a revaluation gain. On the other hand, depreciation, overcharge, this one arises whereby the subsidiary company revalued the asset and there was a revaluation loss. Though we say that the common scenario is whereby the subsidiary company revalued the assets and there was a gain. There was a gain. So meaning that in such a case, what you do, you have to determine the depreciation other charge, and specifically for the current financial year only. That is a keyword here, for current financial year only. Reason being, when preparing the income statement, we only take into account the incomes and expenses for the current financial year. Because if, for example, from the date the subsidiary was acquired, that is from the date of acquisition to the date of consolidation here, assuming you have like 3 years. So mean that the subsidiary will have other charge, or basically we are going to have a depreciation other charge for how many years? 3 years. But now in preparing the consolidated income statement, we only consider the depreciation other charge for the current financial year only. For the current financial year only. So therefore, that depreciation other charge for the current financial year, this one, unless told otherwise, this one is always added to group cost of sales. To group cost of sales. Reason being that depreciation is always supposed to be included as part of the cost of sales. But there are some instances whereby the examiner can tell you that the depreciation of the asset is included as part of the administrative expenses. If you are given that information, then that depreciation other charge, you will not add it to the group cost of sales, but rather you add it to the administrative expenses. But if the question is silent, add it to the group cost of sales. Then in case there was a depreciation overcharge for the current financial year, this one should be deducted, from the group cost of sales, and purely that is depreciation overcharge for the current financial year only. For the current financial year only. So that is the other adjustment here. And then finally we have adjustment relating to impairment loss. Impairment loss. So impairment loss, first of all, you have to recall what we have already discussed in our previous sessions, that impairment loss is the reduction in the value of goodwill. Anytime the value of goodwill reduces, we refer to that as impairment loss. So when preparing the consolidated income statement, any impairment loss for the current financial year should be included as part of the administrative expenses, as part of the administrative expenses. So therefore, you can say that impairment loss for current financial year, should be added to administrative expenses, to the administrative expenses. And in this case, it is the full amount. It is the full amount of the impairment loss, because when computing now the goodwill, or when we compute the goodwill using the full goodwill method, the impairment loss which we determine is the impairment loss attributable to the parent company goodwill and to the NCA goodwill. So it is the full amount of the impairment loss which you add to the administrative expenses, not the impairment loss attributable to the goodwill of the parent, or impairment loss attributable to the goodwill of the NCI. So you add the full amount of the impairment loss to the administrative expenses. So therefore, these are some of the key consolidation adjustments which you must be aware of, and basically which you must be able to deal with them specifically in preparing a consolidated income statement. So for the time being, I want us we stop at that particular point. Once we come back in our next session, I want us we look on an illustration regarding how to prepare, or regarding how to present a consolidated income statement, so that you can be able to understand how we prepare the same, and actually how to deal with some of those particular key consolidation adjustments. So see you in the next session.